Imagine spending like $200 million on a building where the concrete hasn't even been fully poured yet.
Right, in a country where you hold an absolute legally mandated monopoly.
Exactly. Using money you strategically borrowed, right before global interest rates went completely crazy.
I mean, it sounds like a hypothetical scenario from a business school case study or something.
It really does.
Yeah.
But that is exactly what's happening right now in Japan. And it's just one small piece of this massive global corporate puzzle we're putting together today.
Yeah, it's a super compelling scenario, and I think it really highlights how the whole definition of hospitality has completely fractured over the last decade.
Oh, totally. Which is exactly why we're taking you on this deep dive today. We've got a remarkably revealing source document in front of us.
We do. It's the extremely detailed transcript of the MGM Resorts International Q1 2026 earnings conference call.
Right. And look, I know the traditional perception of an earnings call. A parade of executives just reading dry math from a spreadsheet.
Ticking off revenue lines while analysts just sort of nod along.
Exactly. But since we focus on breaking down these calls for retail investors, our mission here is to look past the jargon. If you look closely at the language here, you don't just find a spreadsheet.
No, you find a window into human psychology. You see shifting global demographics.
Yeah, and the hidden economics of major sports events. Plus, you get to watch a legacy empire aggressively rewrite its own business model.
To truly understand the maneuvers management is making here, and they are making some highly unusual ones, we really need to establish the sheer scale of their chessboard.
Right, because MGM Resorts isn't just a localized casino operator on the Vegas Strip anymore.
Not at all. Their portfolio is vast. You've got the domestic core in Las Vegas, which honestly operates almost like its own sovereign economy.
Definitely. And then a sprawling network of regional casinos across the U.S.
Plus a massive footprint in Macau under MGM China, a rapidly expanding digital betting arm, and those mega projects under construction in places that have never even had physical casinos before.
It's a sprawling empire. But as we comb through the dialogue from CEO Bill Hornbuckle and CFO Jonathan Halkyard, a very distinct overarching narrative really emerges for this quarter.
Right. The tension in this call is palpable. On one side, they are achieving just unprecedented top-line growth.
Yeah, massive pivot toward live events, conventions, high-end luxury.
But on the flip side, they're fighting these bizarre legal battles, dealing with entire demographic segments vanishing and dealing with, frankly, profound frustration over how Wall Street is valuing them.
So let's start with the headline numbers and the core engine of their revenue, Las Vegas.
Yeah, let's look at the data. Vegas top-line revenue grew year over year for the first time in 6 quarters.
A year and a half. I mean, that is a significant period to wait for the main revenue needle to point up again.
Right, especially in an inflationary environment where costs are constantly rising. But what makes this growth notable is how they achieved it.
It wasn't just casual tourists pulling slots, was it?
No, not at all. It was a highly orchestrated surge in group and convention business. The transcript points to massive citywide conventions like CES and CONAG.
Oh, wow. And conventions provide that predictable base layer of occupancy, right?
Exactly. They reported a record first quarter for conventions, which drove substantial increases in what they call production ADR.
Okay, let's pause and translate that Wall Street jargon for a second. Average daily rate, ADR, makes sense. But what is production ADR?
Right. So production ADR refers to the rate achieved from group bookings that are contracted well in advance, sometimes years ahead of the event.
Ah, okay. So unlike a random Tuesday booking that fluctuates based on demand algorithms?
Exactly. It's a guaranteed revenue floor. In Q1, their convention room night mix pushed up 2 full percentage points year over year.
Hitting 20%, right?
Sure.
1 in 5 rooms filled by convention attendees.
Which is a staggering amount of guaranteed inventory. And these attendees bring corporate expense accounts for high-margin dining and catering.
So that's the corporate suit half of the Vegas evolution. But the other half, which completely dominated this call, is the sheer volume of sports integration.
Las Vegas has meticulously repositioned itself as the ultimate sports town, and MGM is perfectly positioned to benefit.
Right. They talked about the massive bump from the 2024 Super Bowl at Allegiant Stadium, but then they immediately pivot to the future.
The timeline is relentless. College football playoff in 2027, the men's Final Four in 2028.
Which happens to be the exact same year the Oakland A's are scheduled to start playing baseball in their new Vegas stadium. And then the NBA.
Yeah, the NBA discussion was fascinating. An analyst asked about expansion, and Bill Hornbuckle didn't even give a standard non-answer.
He literally said, I am already under 3 NDAs, 3 separate non-disclosure agreements.
Right. He confirmed active, high-level engagements to bring a team to the T-Mobile Arena, which MGM owns a huge stake in.
It sounds like MGM is treating their Vegas footprint less like traditional casinos and more like the VIP suite of the world's biggest sports stadium.
That's a great analogy. It's a deliberate strategy of premium proximity. You own the beds and the bars closest to the stadium. You price them accordingly.
But wait, I have to ask, what's the bottom line risk here? What happens if the global consumer stops traveling for these massive, expensive tentpole events because of inflation?
That's the exact vulnerability analysts probed. Management's defense is this concept of structural resilience.
Structural resilience, meaning what exactly?
Meaning they cater to the high-end luxury consumer, the VIPs who don't change their travel plans just because gas went up 50 cents.
Oh, I see. So their premium positioning essentially creates a moat against standard economic cycles.
Exactly. But that transitions us to the second major theme. Because if the luxury weekend business is booming, what about the average consumer?
The missing middle. Yeah, this was wild. Management openly admitted midweek softness at their lower tier properties, specifically Luxor and Excalibur.
Right. And there's a fascinating, highly specific demographic shift driving this. The traditional Canadian tourist base is down 30 to 40%.
30 to 40%. That's a massive cratering of a reliable customer base.
It is. So you have these massive properties sitting with thousands of empty rooms on Tuesdays and Wednesdays. And an empty hotel room is a perishable asset.
Once the night passes, that revenue is just gone forever.
Yeah.
But they can't just slash prices to $10 a night, right?
Oh, because then you attract a demographic that won't spend a dime on the property. So their solution is importing the Cancun-style all-inclusive package to the Vegas Strip.
Which is such a radical departure from the Vegas model. Vegas is famous for nickel and diming you with resort fees, parking fees, $20 cocktails.
Exactly. But this new pilot program bundles the room, dining, entertainment, and fees into one single upfront price tag.
Creating absolute price certainty, which makes total sense for a budget-conscious traveler terrified of hidden costs.
It's brilliant. You just tell the guest, pay this, and you can literally leave your wallet in the hotel safe.
And the data shows it's working. Roughly 1/3 of the bookings for this package are from first-time Las Vegas visitors.
Which is the absolute lifeblood of long-term casino growth. Hornbuckle noted first-time visitation had plummeted into the low teens recently.
Down to like 8 or 9% last year, right? That's an existential threat. You need new blood.
Exactly. So grabbing these first-timers with a predictable price point is a masterclass in customer acquisition.
But wait, does making it all-inclusive kill the spontaneous, wallet-draining wandering that casinos rely on? If my meals are paid for, do I even walk near a blackjack table?
Analysts push back on that exactly, but the COO, Aisha Molino, said the financial flow-through is still positive.
Oh, really? So it actually frees them up to spend more on the casino floor?
It seems to. Mentally, the guest categorizes their remaining budget purely as entertainment capital. They're not worried about affording dinner, so they risk more at roulette.
Wow, optimizing wallet share by removing the anxiety. That's smart. But speaking of anxiety, let's talk about how they're losing money.
Ah, yes. The great anomaly in the financial ledger.
Right. So revenue is up, but CFO Jonathan Halkyard pointed out a sharp decrease in EBITDA. Profit margins are actually contracting. Why?
Two things. First, a $31 million drop in business interruption proceeds. Basically an accounting timing issue from an old cyber attack.
Okay, that's just a one-time paper. But the second one?
The second is a massive $37 million spike in self-insurance expense in Vegas, plus another $9 million in the regional sector.
$46 million. Vanishing from the bottom line. And Halkyard went on this highly unusual rant about it, didn't he?
He did. He specifically blamed a growing prevalence of frivolous litigation backed by large pools of capital.
Right. He was pointing the finger directly at private equity firms, acting as third-party litigation funders.
Yeah, TPLF. It's this industry where private equity treats civil lawsuits like an alternative asset class. They fund the plaintiff's legal fees for a cut of the settlement.
So Wall Street bros are basically underwriting slip-and-fall lawsuits on the casino floor.
That is the functional reality. And they do it because the math works. If a backed plaintiff sues MGM for a tripped carpet seam, the discovery costs for MGM are astronomical.
Oh, right. MGM has to pull surveillance footage, depose housekeeping, dig up maintenance logs.
Exactly. It might cost MGM $100,000 just to prove they weren't negligent. The private equity firms know this.
So it's mathematically cheaper for MGM to just hand over a $50,000 settlement to make it go away. It's an arbitrage on legal friction.
Precisely. And Halkyard is furious because that $46 million is capital diverted directly away from property investments or share buybacks.
Oh, if I'm an investor listening to this, how worried should I be? Is this permanently eroding profit margins?
An analyst from JP Morgan basically asked that exact question. Halkyard framed it as pulling forward the expense to fortify reserves, hoping it's a one-time adjustment.
He certainly hoped not, I think he said. But obviously it's a new risk factor. Now let's cross the Pacific, because we need to talk about Macau.
Yes. Macau is their biggest international growth engine. And MGM China had an extraordinary quarter.
The headline numbers here are wild. A 9% net revenue bump. And they secured a 17.3% market share by the end of the quarter.
Which is formidable. Pre-pandemic, MGM was routinely around a 9 or 10% market share. To almost double that is profound.
It is. But as I read the transcript, I noticed this massive corporate move that felt like it totally flew under the radar. The brand fee.
Oh, the brand fee adjustment is a brilliant exercise in financial architecture.
Break this down for us, because this is the kind of actionable intelligence Top Tickers listeners love.
Right. So MGM Resorts, the U.S. parent, doesn't own all of MGM China. They own about 56%. The rest is public in Hong Kong.
Okay, so if MGM China issues a dividend, the U.S. parent only gets 56% of that cash. The rest leaks to minority shareholders.
Exactly. But starting this year, the U.S. parent doubled the brand fee, a royalty for using the MGM name, from 1.75% to 3.5% of top-line revenue.
Which deducts the money before profits are even calculated.
Yes. It magically funneled an additional $23 million in pure cash directly back to Las Vegas this quarter alone. Zero leakage.
That is flawlessly executed corporate strategy. But they're also doing things on the ground in Macau to earn that revenue, right? It's all about premium mass.
Right. The old Macau was about packing thousands of lower-tier gamblers into giant halls, but the Chinese government cracked down on VIP junkets.
So now it's hyper-targeting the affluent customer. The transcript mentions 63 brand-new suites on the Cotai side, and they called them cozy.
Cozy is such a telling word choice. Old Macau was aggressive opulence gold, massive marble columns. Cozy signals residential luxury, extended stays.
They also renovated 40,000 square feet of premium gaming space. But my absolute favorite detail from the call was about the actual table games, the baccarat side bets.
Oh, the prop bets. This was a fascinating revelation during the Q&A about consumer psychology and casino math.
Right, so an analyst noticed the casino's hold, the percentage of chips they mathematically keep, was trending way higher than historical averages.
And Hornbuckle revealed it's because players are aggressively adopting side bets. Some baccarat tables now have up to 6 different side bet options.
Why does that matter so much to the bottom line?
Because the base game of baccarat has a tiny house edge, like barely over 1%. It's basically a coin flip.
So you have to grind out massive volume to make real money on that 1%.
Exactly. But a side bet like betting the first 2 cards are a perfect pair might carry a house edge of 10, 12, or even 15%.
Wow. And the players are just eager for that high multiplier jackpot thrill, so they take the bait.
Yes. The casino doesn't have to hire new dealers or change the base rules, which legacy players hate anyway. They just structurally elevate their profit margin.
It's pure, unadulterated profit dropping right to the bottom line. So Macau is crushing it. But where is the future growth? What about the digital frontier?
The digital growth metrics are staggering. BetMGM North America grew a solid 6%, mostly driven by iGaming.
Right, digital slots and blackjack.
Yeah.
But the real star is MGM Digital, the international arm, up an incredible 43%.
Largely driven by their LeoVegas brand booming in the UK and Sweden. And their strategy now involves heavy spending in Brazil ahead of the World Cup.
Yeah, the president of MGM Digital warned they might blow past their financial guidance in Brazil because the total addressable market is just so vast.
It's a classic land grab strategy. They're willing to stomach short-term operational losses to aggressively acquire a dominant market share.
So digital's booming. But they are still building physical empires, like Osaka, Japan, targeting 2030. Hornbuckle said this project has been 17 years in the making.
17 years of lobbying, and it's an active construction site now. 40% of the foundation piles are done.
And the numbers are staggering. An addressable market of 120 million residents, plus 40 million tourists. And MGM will be the sole licensed operator in Japan.
The absolute holy grail, a legalized monopoly in a high-wealth nation.
Plus, they executed this brilliant financial hedge. They have $200 to $225 million left to spend this year, completely pre-funded by a yen-denominated credit facility.
Right, because Japan has 0 or negative interest rates. So they borrow cheap in yen, which also hedges against the yen revenues they'll eventually generate.
Incredible treasury management. But there's another unbuilt empire they talked about. The UAE mystery.
Yes, the Dubai project. Officially, it's a strictly non-gaming luxury resort, but an analyst asked about it, and Hornbuckle dropped a massive detail.
He casually mentioned they are secretly holding a 250,000 square foot space on a podium floor, just entirely empty.
Just waiting in the wings.
It's like buying a massive, expensive picture frame and leaving it empty on your wall, praying the government eventually lets you put a masterpiece inside it.
It's an undeniably expensive gamble. But if the UAE legalizes casino gaming, MGM instantly has a fully constructed gaming floor years ahead of competitors.
Strategic optionality at its finest. Okay, so we've got record Vegas conventions, Macau cash flows, a digital rocket ship, and monopolies in Japan and maybe Dubai.
Firing on all cylinders. Which brings us to the core frustration of management on this call.
The Wall Street disconnect. If the company is doing this well, why are they just buying their own stock instead of building more?
Because they believe the public equity markets are fundamentally undervaluing them. The CFO, Halkyard, was practically begging analysts to do the math.
Yeah, he specifically brought up Northfield Park, right? A simple slot-only facility in Ohio with no hotel.
Right. They sold it for 6.6 times its trailing EBITDA. Yet the entire MGM enterprise trades at a significantly lower multiple on the open market.
The market is valuing the Bellagio and a Japanese monopoly at a lower multiple than a random Ohio slot parlor. That's insane.
Wall Street tends to discount complexity. The OPCO-PROPCO structures, Macau geopolitical risk, massive capex in Japan.
So because the market is undervaluing them, MGM's strategy is basically to eat themselves. They bought back 2.5 million shares for $90 million just this quarter.
And over the last 5 years, they've essentially shrunk the company's total outstanding share count by 50%.
They retired half the company,
Yeah.
which naturally puts a massive floor under the stock price for retail investors.
Exactly. Every time they retire a share, your slice of the pie gets bigger.
But if your parts are consistently worth more than the whole, and you've bought back half your company, at what point does a massive public company just take itself private?
It's a fascinating question. If the market never corrects to reflect fair value, partnering with private equity or a sovereign wealth fund to go private is the logical endpoint.
Absolutely. So bringing it all together, what's the bottom line here for the listener?
The synthesis is that MGM Resorts is no longer just a casino operator relying on slot machines. They are a diversified global entertainment ecosystem.
Yeah, extracting value through premium targeted experiences, whether that's a prop bet in Macau, a tech convention in Vegas, or a World Cup bet in Brazil.
They've built an economic moat around luxury and structural resilience.
But digesting all this leaves me with one final provocative thought for you to ponder.
What's the scenario?
Well, as MGM exports the Vegas model to Osaka and heavily pushes the digital BitMGM brand worldwide, will there come a day when the physical neon-lit casino floor in Nevada is just a marketing loss leader?
Oh, interesting. Like a physical billboard for the digital empire.
Exactly. Will iconic properties like the Bellagio eventually just exist to legitimize and advertise a massive, higher-margin global digital betting empire that lives entirely in the cloud?
It's a profound strategic question, subsuming the physical spreadsheet into the digital ecosystem.
Just as we established at the beginning, the traditional spreadsheet is broken, and a complex global ecosystem is thriving in its place. Thanks for taking this deep dive with us today.
It's been a pleasure to unpack it all with you.